Hey, it's Kevin Thompson, and today we're talking about Jerome Powell and Econ 101 and what he talked about during his latest hearing. Let's take a quick listen.
Inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
Powell says they're leaving interest rates unchanged. That means they're not moving them up, they're not moving them down, but he did mention something 19 times in this meeting. That is policy uncertainty.
We also made the technical decision to slow the pace of decline in the size of our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged.
So let's put this in layman's terms. What is Jerome Powell saying? By reducing the Treasury's cap from $25 billion to $5 billion, they're effectively reducing the amount of treasuries that are into the market, which ultimately increases the prices, which also reduces the yields, which brings down borrowing costs for the end consumer.
Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Uncertainty around the changes and their effects on the economic outlook is high. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. People
are pulling back. Retail spend, people are holding on to more cash, not spending on discretionary. Businesses pulling back, not knowing what their cost of inputs are. So people are slowing down.
Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures.
The Fed has a dual mandate: price stability and full employment. Right now, employment is looking good. There's no inflation there. The job market steady? Price stability, a little higher than expected, but they are managing it and will continue to look at the dynamics as they come. Thank you guys for listening to 990's podcast. Thank you guys for listening to 990 in the news. And thank you for listening to this segment on Econ 101. Stay humble, stay safe. See you again soon.